Corporate Crimes, Script Episode, The Enron Scandal, The House of Cards. Duration, maybe 10 minutes. Cold open, hook. Narrator. In December 2001, the seventh largest company in America, a company that Fortune magazine had named America's most innovative company for 6 years running, collapsed. Not in months, not in weeks, in days. 27,000 employees lost their life savings. Wall Street lost billions, and the phrase "cooking the books" entered the American lexicon forever. What happened at Enron wasn't just a fraud, it was a masterpiece of deception, built by some of the smartest people in the room, and when it fell, it took the entire accounting profession down with it. Act 1. The Rise. Narrator. To understand the crime, you have to understand the myth. Enron started in 1985 as a boring natural gas pipeline company, a merger of Houston Natural Gas and Internorth. Boring, but profitable. Then in 1990, a Harvard Business School golden boy named Jeffrey Skilling joined the company. Narrator. Skilling had an idea that would transform Enron from a stodgy utility into a Wall Street darling. Why just sell gas when you could trade it? He created a gas bank. Enron would buy gas from producers, sell it to consumers, and pocket the spread. It was financial engineering applied to energy, and it worked brilliantly. Enron became a trader's paradise, aggressive, smart, and utterly dominant. Narrator. By the late 1990s, Enron was trading everything: natural gas, electricity, bandwidth, even weather derivatives. The stock skyrocketed. Ken Lay, the CEO, was friends with the Bush family. Skilling was hailed as a visionary. The company was untouchable, but there was a problem, a big one. ACT-2, the engine of deception. Narrator. Enron's actual business, trading energy, was real, but it wasn't profitable enough to justify the stock price, so Skilling and his team turned to accounting tricks to make the numbers look much better than they actually were. The first trick, mark-to-market accounting. Narrator. Normally, when you sign a long-term contract, you record the revenue as you deliver the service, but Enron got permission to record the entire projected profit of a multi-year deal on day one. So if Enron signed a 10-year, $1 billion contract, they'd book $200 million in profit immediately, even if they hadn't done any work yet, and even if the deal eventually lost money. It's like buying a house and immediately claiming its rental income for the next 30 years. It was legal, but it was a house of cards, because eventually those projections had to come true. Narrator. The second trick, special purpose entities, or SPEs, and this is where Enron's CFO, Andrew Fastow, got creative. Narrator. Enron was taking on massive debt to finance its trading operations, but debt scares investors, so Fastow created hundreds of off-balance sheet partnerships, shell companies that were technically independent but actually run by Enron executives. Enron would move its debt and its worst-performing assets into these SPEs. On paper, Enron looked profitable and debt-free. In reality, the debt was just hidden in a closet. And here's the part that crosses the line from aggressive accounting to outright fraud. Fastow put himself in charge of these partnerships and made millions in management fees without telling Enron's board or its shareholders. It was a conflict of interest so blatant that when it was finally exposed, even hardened Wall Street analysts were shocked. Narrator. By 2000, Enron was reporting $101 billion in revenue and profits of $979 million, but its actual cash flow was negative. The company was generating no real money. It was a Ponzi scheme disguised as an energy company. Act 3. The Whistleblower. Narrator. In August 2001, an Enron vice president named Sharon Watkins sat down at her computer and typed a letter. She had been crunching the numbers, and what she found terrified her. Narrator. She wrote, "I am incredibly nervous that we will implode in a wave of accounting scandals." She went on to describe the SPEs as a ticking time bomb. She took the letter to Ken Lay personally. Narrator. Lay assured her he would look into it. He did not. Instead, he brought in Vinson & Elkins, the very law firm that had helped design the SPE structure, to conduct a review. Unsurprisingly, they found nothing wrong. Meanwhile, Jeff Skilling had abruptly resigned as CEO in August 2001, citing personal reasons. In hindsight, he saw the iceberg and jumped overboard. Lay stepped back into the CEO role, but it was too late. The ship was already taking on water. Narrator. On October 16, 2001, Enron announced a $618 million quarterly loss and a $1.2 billion reduction in shareholder equity. The stock started to slide. Then, on October 22nd, the SEC launched an investigation into the SPE partnerships, and then everything unraveled. Act 4, The Crash. Narrator, November 2001. The dominoes fell in rapid succession. Narrator, November 8th. Enron restated its earnings going back 4 years, $586 million in losses that had never been reported. November 9th, Dynegy, a smaller energy trader, agreed to buy Enron for $8 billion, but when due diligence revealed the true scale of the debt, Dynegy backed out. November 28th, credit rating agencies downgraded Enron to junk status. The stock, which had peaked at $90, was now trading at 61 cents. November 29th, Enron shares briefly hit zero. November 30th, the European trading operations shut down. Staff were told to clear their desks and leave. Narrator, December 2nd, 2001. Enron filed for Chapter 11 bankruptcy. It was the largest bankruptcy in American history. $63 billion in assets. Thousands of employees who had their 401s locked in Enron stock watched their retirement savings evaporate overnight. Many had been explicitly encouraged by management to buy more Enron stock, even as executives were secretly selling their own shares. In the hearings that followed, Ken Lay and Jeff Skilling pleaded ignorance. Lay said he was shocked and had been deceived by his subordinates. Skilling blamed Fastow. Fastow blamed no one. He took the fifth. The American public was not buying it. Act 5, The Aftermath. Narrator, the Enron scandal didn't just destroy a company, it triggered a reckoning. Ken Lay was convicted on 10 counts of fraud and conspiracy in 2006. He faced up to 45 years in prison, but he died of a heart attack in July 2006 before sentencing, so his conviction was later vacated. Jeff Skilling was convicted on 19 counts, including securities fraud and insider trading. He was sentenced to 24 years in federal prison. He served 12 and was released in 2019. Andrew Fastow, the CFO who built the SPE empire, pleaded guilty to 2 counts of wire and securities fraud. He cooperated with prosecutors and got a 6-year sentence. He served about half of it. Narrator, and then there was Arthur Andersen, Enron's accounting firm, one of the big 5 in the world, was convicted of obstruction of justice for shredding Enron documents. The conviction was later overturned by the Supreme Court, but the damage was done. Arthur Andersen lost its licenses, its clients, and its reputation. It went from 85,000 employees to 0, an entire firm erased. The scandal also led directly to the Sarbanes-Oxley Act of 2002, the most sweeping corporate reform legislation since the Great Depression. It tightened accounting standards, increased penalties for fraud, and required CEOs to personally certify their financial statements. Narrator, the irony? Sarbanes-Oxley made it harder to pull in Enron, but it didn't stop the next scandal. It never does, because fraud doesn't come from bad accounting rules. It comes from bad people and a culture that rewards them until the very moment it doesn't. Closing. Sharon Watkins. I knew we had a problem, but I didn't know how big it was. Narrator. The Enron scandal is a cautionary tale about what happens when smart people stop asking hard questions. It's about the corrupting power of money, the failure of supposed watchdogs, and the human cost of unchecked ambition. Enron's most innovative trick wasn't energy trading. It was convincing everyone, investors, regulators, employees, the media, that a house of cards was a skyscraper. And when the last card fell, it took a lot of innocent people with it. End of script. Total estimated runtime, 10 minutes. Production notes, B-roll, public domain news archives, SEC filings, Enron annual report covers, trading floor footage. Key archival, Ken Lay, Skilling congressional testimony, Sharon Watkins interviews,